Right now, Iran is deploying economic tactics, blockading the Strait of Hormuz. This single tight shipping lane controls 20% of the world's oil supply. When tankers stop getting through, the effects hit the U.S. economy almost instantly. Jet fuel prices jump, shipping and trucking rates rise, and retailers are forced to pass those costs directly down the line. We see this show up rapidly at the pump. It pulls cash out of the pockets of everyday consumers, leaving them less to spend, while simultaneously eroding the profit margins of the companies they buy from. We have seen exactly this setup before. The OPEC embargo of 1973, the Iranian Revolution in 1979, and the Gulf War spike in 1990 all triggered massive disruptions in global energy markets. This chart shows historical oil prices spiking alongside an aggressive jump in the consumer price index. Economists call this cost-push inflation. Unlike a roaring economy where high demand drives prices up, an oil shock forces prices higher simply because the foundational inputs are choked off, even as the broader economy weakens. Because the root cause is a broken supply chain rather than overactive consumer spending, the Federal Reserve is largely trapped. Raising interest rates cools demand, but it cannot manufacture barrels of crude oil or force tankers through a blockaded strait. As inflation eats into your purchasing power, the immediate temptation is to try and fight back. Many investors watch crude oil jump from $64 to over $110 a barrel and decide they need to start trading energy futures to offset their daily losses. Looking at this decision tree, you essentially have two paths. You can veer left and try to time the commodities market, or you can veer right and focus on holding productive assets. Warren Buffett has actively invested through every major oil shock of the last half-century. In 3 out of the 4 largest energy crises, he successfully deployed capital and continued to beat the broader market. His approach completely ignores the left side of that decision tree. He avoids trying to predict the direction of raw materials, stating repeatedly that he has no special insight into where energy markets will go next. You face a clear choice: place bets on the unknowable decisions of foreign leaders and military commanders, or buy stakes in cash-generating businesses whose underlying economics you can actually analyze. Let's look at trading energy futures right now. Investors are glued to screens, trying to anticipate market movements based on breaking news. The problem is that crude prices are currently detached from standard supply and demand metrics. They are being dictated by missile strikes, drone activity, and retaliatory embargoes. Charlie Munger noted that seasoned experts struggle to find an analytical edge predicting the 10-year trajectory of materials like copper, cotton, or natural gas. Trying to navigate these violent swings gives you the illusion of control and the slim chance of a rapid windfall. The cost is abandoning the primary rule of investing, protecting your initial capital. Moving money into oil right now is purely a speculative play. As a retail investor operating on a delay to global news, you enter an arena where you are guaranteed a severe disadvantage. The alternative path is acquiring shares in what Buffett calls wonderful businesses. These are companies selling products that people will continue to purchase no matter how bad the economic environment gets. As raw material and transportation costs rise, typical businesses suffer. They face a price-sensitive consumer base, steadily compressing profit margins until the business bleeds cash. To survive, a company needs a specific economic defense. This checklist breaks down the ideal protection against inflation, starting with deep brand loyalty and high customer switching costs.
Companies with high brand strength or deeply embedded software possess pricing power. Pricing power is the ability to raise the cost of your product in lockstep with rising inflation, while suffering almost zero drop in sales volume. The brand does the heavy lifting, keeping customers paying the higher rates. The catch is that the broader market usually knows exactly how valuable these premium companies are. Acquiring them requires immense patience, as they rarely trade at deep discounts under normal conditions. A company's earning power, shielded by its brand and separate from raw commodities, is the most effective way to protect wealth from cost-push inflation. You also have to filter out capital-intensive businesses. Mining companies, raw material producers, and traditional utilities are exceptionally vulnerable during periods of stagflation. Because their operations are physical, rising equipment and labor costs force these companies to plow massive amounts of cash back just to maintain baseline output. Compare that to Buffett's investment in See's Candies. The business scaled revenues from $30 million to over $300 million, yet it only required $30 million of total capital reinvestment to achieve that 10x growth. Today, we see this asset-light model in software and payment networks like Visa and MasterCard. As prices rise, the dollar value of transactions on their network increases, expanding their revenues without the need to build a single new physical factory. The specific risk to acknowledge here is that software and technology moats can be disrupted by new competitors much faster than a heavily regulated physical utility monopoly. Businesses that require endless capital just to exist will slowly suffocate as their operating costs soar, while asset-light companies can lean on their brands to seamlessly capture the upside of rising prices. Let's map pricing power vertically and capital requirements horizontally. The bottom left quadrant is the value trap, heavy industries with high capital needs that destroy wealth during an oil shock. The top right is the goal, strong asset-light brands, perfectly positioned to absorb macroeconomic shocks. The advantage of an economic panic is that it drags down the entire market indiscriminately. This turbulence often causes the exceptional companies sitting in the top right corner to briefly trade at highly attractive valuations. Concentrating your holdings in this top right quadrant protects your capital from the erosion of an oil shock more effectively than speculative trading. If you are looking at the current data and feeling anxious, that reaction is entirely justified. The supply disruptions of the late 1970s drove U.S. inflation near 15%, severely damaging the buying power of the average citizen. Your most profitable move right now is total inaction in the energy markets. Do not try to time the complex geopolitics of the Middle East. Let the speculators take those brutal losses. If you want to optimize your existing investments, start running a strict bottom-up analysis on every stock you own. Apply the capital intensity filter and test them for pricing power. Identify the companies in your portfolio that require massive, ongoing capital expenditures just to survive. If they lack the brand strength to raise prices, seriously consider trimming those positions before operating costs eat their margins alive. Real wealth protection during a global panic comes down to discipline. It means turning off the daily news alerts, stepping away from the commodities casino, and committing entirely to holding exceptional, cash-producing assets for the long haul.